Welcome to Iron Financial, the show where we help you forge a stronger portfolio by cutting through all the market weakness. All right, today, Aflac is on the anvil. Their Q4 2025 earnings just dropped, and honestly, the numbers are telling two completely different stories. On one hand, you've got what looks like a dividend fortress, a real champion of capital returns that shareholders absolutely love. But on the other hand, you've got a kingdom with a shrinking top line. We're talking revenue is down, GAAP earnings have cratered. So, the big question is this company built on solid rock, or is that foundation starting to show some serious cracks? Let's get to work.
Yeah, exactly. And that right there is the question every single investor needs to be asking themselves. It's so easy to get hypnotized by that rising dividend, right? It feels safe. It feels like a sure thing. But is it just a fresh coat of paint on a structure that's actually rotting underneath? Look, management wants you to see this impenetrable fortress for your income portfolio. But our job here is to look for the cracks, the really dangerous ones that could bring the whole thing crashing down. And that's exactly what we're here to find out.
Okay, here's our game plan. We are running a full structural analysis on this thing. First up, we're going to untangle what we're calling the Aflac paradox, those contradictory headlines that are confusing the market. Second, we'll dive into how they actually built this dividend fortress and look at the sheer firepower behind their capital returns. Third, we're going straight into the engine room to break down the performance in Japan versus the US. Fourth, we'll inspect the foundation. We're talking about the huge chasm between their official GAAP numbers and their preferred adjusted reality. Fifth, the skeptic is going to walk us through the wall of worry. These are the risks Aflac itself is flagging for investors. And finally, we deliver the iron financial verdict. Let's start digging.
All right, Section 1, the Aflac paradox. Look, if you just skim the Q4 2025 headlines for Aflac, you are getting some seriously mixed signals. You could build a compelling case for being a raging bull or a terrified bear from the exact same report. So our first job is to separate the signal from all that noise. This slide right here is the entire paradox in a nutshell. Just look at the left side at the bear case. For the full year, total revenue fell 9.3%. Now that's not a rounding error. That is a significant drop from $18.9 billion down to $17.2 billion. That's a real contraction. And what's worse, look at the GAAP net earnings. They plummeted 33%. That's a 5-alarm fire in my book. But then, management tells you, hey, look over here to the right at the bull case. Their favorite metric, adjusted earnings per share, is actually up 3.9%. And on top of that, they just jacked up the dividend by another 5.2%. So how in the world does a company with shrinking sales and collapsing profits afford to give everybody a raise? That's the conflict we have to resolve.
And right on cue, here we have the official story from the CEO, Daniel Amos. Aflac delivered solid earnings. Solid? Really? Your revenue just shrank by nearly 10% and your profit fell by a third. What part of that is solid? And then you get this phrase, creating long-term value for shareholders, which is the classic corporate speak we have to challenge. You have to ask, does creating value mean growing the underlying business, selling more policies and increasing real operational profit? Or does it just mean using financial engineering like massive share buybacks to shrink the share count so that your earnings per share goes up even while your total earnings are falling off a cliff? Because it looks a lot like the second one, and that's a strategy that has a definite expiration date.
That is a completely fair challenge, and it brings us right to our next section. To understand the bull case for Aflac, you have to appreciate the company's absolute obsession with returning capital to its shareholders. It's not just part of their strategy. For them, it is their strategy. They've built a financial fortress, a citadel designed to withstand almost any storm, and it's funded entirely by these capital returns. So let's inspect the building materials. 43 consecutive years of dividend increases. Just stop and think about the discipline that requires. This company has weathered recessions, market crashes, interest rate chaos, a global pandemic, you name it. And through all of it, every single year for over 4 decades, they gave their shareholders a raise. This is how you earn the title Dividend Aristocrat. This right here is the bedrock of their entire bull case, a track record of reliability that is incredibly difficult to argue with.
And this isn't some ancient history we're talking about. Right now, staring down those ugly declining revenue numbers, they just announced another 5.2% dividend hike for the first quarter of 2026. This is a powerful statement of confidence coming from the board. They're basically telling the market, yeah, we see the ugly headlines, we get it, but we have the capital, we have the cash flow, and we are not backing down from our commitment.
Now, the second pillar of this fortress is the buyback program.
And the scale of it is just staggering. Look at this number, $3.5 billion. That is what they spent in 2025 alone, just buying back their own stock. $800 million of that was in Q4. This is the financial engine that's doing all the heavy lifting, the thing that's driving that adjusted EPS growth. By taking shares off the market, they concentrate ownership and they juice the per-share metrics. Make no mistake, this isn't an accident. It's an aggressive, deliberate capital return strategy, and it's a massive part of the Aflac story.
But this brings us right back to the fundamental question, the skeptic's question. We see that $3.5 billion, and we have to ask why. Is this really a sign of overwhelming strength, that they're just generating so much cash they can't help but give it all back? Or, and this is the big one, is this a sign of weakness? Is the company returning this amount of capital because it has looked around and it literally can't find any compelling opportunities for reinvestment and growth? A young, growing company would be plowing that cash back into the business to expand. Aflac is doing the exact opposite. So is this a mature, shareholder-friendly company, or is it a company that's tacitly admitting its best growth days are long behind it? That's the tension right here.
That's the critical question. And to answer it, we have to go deeper. We have to get into the engine room. The top-line numbers you see are a blend of two very different stories. You simply cannot understand Aflac without understanding the operational split between its two core markets, Japan and the United States. They're performing very, very differently, and the details here are everything.
Okay, so in the engine room, you see two totally different machines running. On the left, you've got Aflac Japan, and they're busy planting new seeds. New sales, mostly driven by a new cancer product, are absolutely booming, up nearly 16% in the fourth quarter. It looks like they're finding fertile ground and really growing the business from the ground up. But hold on a second, planting new seeds is great, but the old forest is shrinking. While those new sales are up, their total book of business, the money coming in from all their existing policies, is still contracting as old policies mature. Their net earned premiums are actually down almost 2%, so they're losing more from the back end than they're gaining at the front. True, it's a battle. But now look to the right, at Aflac US. This is the vault. It's not really about planting new seeds over here, it's about harvesting the cash from a mature, stable business. And the overall book of business here is actually growing slowly, with net earned premiums up 4%. But the vault is leaking. I mean, look at that profit margin. It's getting crushed. The pre-tax profit margin fell from almost 20% all the way down to 17.4%. So that stable cash cow is becoming less and less profitable, which is a major red flag for the entire operation.
Yeah, let's just isolate that U.S. margin decline for a second, because this is a really serious problem. This chart shows the pressure they're under. A drop from 19.7% to 17.4% in a single year is a big deal. The company's excuse is higher benefits and expenses. Well, that's not an explanation. That's just a description of a business that's less profitable. Is this the new normal? Are their products mispriced? Is the competition just eating their lunch? For a segment that's supposed to be the stable profit engine, this is a serious crack in the armor. We will be watching this like a hawk.
That margin compression is a crucial point, and it feeds directly into all the confusion around their headline earnings. This brings us to the foundation of the company itself. The huge gap between what the accountants say happened, that's GAAP earnings, and what the company wants you to believe happened, their adjusted earnings. This is where companies can sometimes hide weakness, so let's put on our hard hats and inspect the blueprints.
Okay, let's just walk through the math here for the fourth quarter. The top line is the official GAAP net earnings, almost $1.4 billion. The company then makes a really big adjustment. They subtract $537 million in investment gains. Their argument is that these market gains are volatile and don't really reflect the core insurance business. After they do that, they arrive at their preferred adjusted earnings number of $818 million. And this is the number they want you to focus on. And this is exactly where I have a major problem. You're an insurance company. You take in premiums from people, and what do you do with that money? You invest it. Your investment portfolio is a fundamental part of your business model. You can't just wave your hands and say, hey, just ignore the $500 million gain we made from our investments. In Q4 of 2024, they had a gain of over $1 billion. Now it's half that. That massive swing is a huge part of the story, and pretending it doesn't exist just to make the operational numbers look more stable feels a lot like hiding the ball.
I understand the skepticism. I do. But the bull case is that this metric gives you a much cleaner signal on the core insurance operations. And if you look at it by that measure, the foundation looks stable. Adjusted EPS for the quarter was $1.57. That's up 0.6% year over year. So while the official GAAP earnings were swinging wildly with the market, management would argue that the core business just chugged along and even grew slightly. That, they would say, is the real signal of foundational strength.
Okay,
Fine, let's play their game. Let's just accept their adjusted number of $1.57 per share as the real number. Well, there's just one tiny problem with that. It wasn't good enough. As this quote from the Associated Press makes crystal clear, Wall Street was expecting $171 a share. So, even by their own heavily massaged, non-GAAP metric, they still missed expectations. The CEO can call the performance solid all he wants, but the market was expecting more strength, and Aflac failed to deliver. That's a miss, plain and simple.
This earnings miss, that margin pressure, the shrinking revenue, it all points to one thing: risk. And that brings us to Section 5, the wall of worry. It's time to stop looking at last quarter's numbers and start focusing on what could go wrong next. And believe me, the best place to find those risks is in the company's own legal filings, where they have to tell you exactly what keeps them up at night.
The number of threats they're facing is pretty immense. I just want to highlight the big ones here. First, that massive concentration of their business in Japan. This company's fate is basically welded to the Japanese economy. Second, and it's related, is the yen-to-dollar exchange rate. Aflac makes billions in yen but has to report its earnings in dollars. A wild swing in that currency can absolutely vaporize their earnings, and it's completely out of their control. 3. IT systems. They specifically mention a security incident back in June of 2025. For a company that holds sensitive data on millions of people, a major cyber attack is a critical vulnerability. These are not small worries. These are structural risks that are baked right into the business.
All right, we've seen the paradox, we've examined the fortress, we've been in the engine room, and we've stared at the wall of worry. It is time to put it all together and deliver the iron financial verdict. Is Aflac a rock-solid income opportunity, or is it a value trap just waiting to spring?
Let's put it on the scale. On the Fortress side, you have that undeniable 43-year dividend growth streak. That is elite territory. You have the aggressive $3.5 billion buyback providing massive support for the stock price. You've got strong new sales growth in Japan, and you have stable, if slow, growth in adjusted EPS. These are the pillars of the bull case. But on the other side of the scale, the cracks are deep. You have the alarming declines in total revenue and GAAP earnings. You can't just wish away a 33% profit drop. You have serious margin compression in the critical U.S. market. You have that heavy reliance on the Japanese economy and the yen wildcard. And you have the undeniable fact that even by their own chosen metrics, they still missed Wall Street's targets. Those weaknesses are real, and they directly challenge the entire narrative of strength.
So, here is our verdict. Aflac is a financial fortress, but it's a fortress that's been built for a specific purpose and for a specific type of soldier. It is built for income investors. If your primary goal is to collect a reliable, growing dividend from a company with a decades-long track record of shareholder returns, then Aflac's fortress is one of the strongest you are going to find. However, if you are a growth investor, somebody looking for a company that is expanding its top and bottom lines, you must be wary of the cracks. The kingdom is shrinking. The declining revenue and GAAP earnings are not something you can just ignore. This is not a growth story.
And that leaves us with the final, critical question you have to keep asking yourself. Is that fortress, built on buybacks and decades of dividends, is it truly strong enough to weather the storms that are on the horizon? Can it withstand the relentless pressure of currency swings and the slow erosion of its U.S. profit margins? Or will we look back in a few years and see that the incredible dividend was simply the last thing left standing on a foundation that was crumbling underneath? That's the risk, and that is the question you have to answer for your portfolio.